Hello, everyone. Sorry about the inconsistent start. I had some technical difficulties. I'm now back. I hope everybody can hear me just fine. Looks like he can. So we're going to call it good. Happy Friday, everybody. This is going to be a talk about the South Sea bubble, which I covered a little bit on a talk, a year ago. I guess I've been doing this for a year, about the financial revolution, which is now lost to time, and I will probably dig back into at some point. But I wanted to talk about just the South Sea bubble because it's interesting to me for a lot of reasons. And I think that it's relevant to the modern day. And I hope that you all find it interesting. This, of course, is going to be very much about England, but its impact on our modern day, on the progression of finance, and on our lives is incalculable. So I think it's very interesting, and I hope that you do too. So our story begins, it has deeper roots than this, but I'm trying to narrow the scope as much as possible so I don't spend all day doing prep and background for this. But more or less, the beginning of our story has to do with England in the late 17th century and with the elevation of William and Mary to the throne in 1688. They were made joint monarchs by Parliament after the previous King James II fled for a whole lot of reasons that are too complicated to go into. But you see William here leading his glorious revolution, technically bloodless, blah, 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 part of England's grand narrative of never being conquered after William the Conqueror, whatever. But as a part of this, the Parliament instituted a Bill of Rights, which added a number of limits to the powers of the monarch and rights and powers for Parliament, including a requirement for regular parliaments, free elections, again, for wealthy and landed men, but still free elections, and freedom of speech in Parliament. It sets out certain rights of individuals, including the prohibition of cruel and unusual punishment, and re-establish the rights of Protestants to have arms for their defense within the rule of the law. Most importantly, though, it includes no right of taxation without Parliament's agreement. This is important because in the sort of long 18th century, about 125 years between roughly this time and the end of the Napoleonic Wars, England was at war with France for 76 out of 126 years. Basically, nonstop war with France or other members of the continent, or really just anybody. Constantly at war. And those wars had to be paid for. And increasingly, they are paid for by borrowing and by debt. And the English government, surprisingly enough, was frequently insolvent and behind on payments to their debtors. So much so that previously Charles, about a couple decades before the Glorious Revolution, had issued a infamous stop on the exchequer, ending all interest payments because they couldn't pay them, which severely damaged England's credit and remained a sort of big black mark on the country for some decades to come. And so they needed a long-term solution for this problem of constantly needing to raise funds and constantly trying to borrow and not having the money to pay interest, especially because almost immediately after becoming king, William got England embroiled in another war, the 9 Years' War. Louis XIV, the Sun King, was at the height of his power, and he was trying to expand the great dominion of France, and so he crossed the Rhine in September of 1688 to pressure the Holy Roman Empire into accepting his territorial and dynastic claims, which are complicated and not important, but just know that the Netherlands was a ally of England, a fellow Protestant power. Leopold I and many of the German Protestant princes resolved to resist, and the States General brought the Dutch and English together into war against France. Now, in the last decades, the Stuarts had kept only about 14,000 men under arms. The average muster of the army that William sent into war to fight in the 9 Years' War topped 76,000. And as part of those, and so the expenditures and the pressure on the increasingly beleaguered English finances only grew. And as you can imagine, this war was going to go on for at least 9 years. So there was a lot to pay for, and it wasn't getting any better. And as part of this war, James II had started a campaign. James II, the deposed Catholic monarch, had started a campaign in Ireland and traveled. And William traveled to confront him, which provoked a naval conflict off the coast of Beachy Head in the English Channel, where the fleet was actually decisively defeated by a French armada. This is Beachy Head you see here. The English panicked. Their monarch was trapped in Ireland, and the Channel was apparently under control of the French, which left England open for invasion. France apparently had no plans or interest in invading, but this was still a grave concern for the English. William did manage to defeat James II's army and recovered, but there were still fears that James II was going to return and invade England with a French fleet. And given that the English fleet had been sort of decimated by this battle, they needed a plan. So first, let's go back in time a bit so I can tell you about joint stock companies, which I love to talk about. The first joint stock company in England launched in 1553, the Muscovy Company, which was originally known as the Mystery and Company of Merchant Adventurers for the Discovery of Regions, Dominions, Islands, and Places Unknown. It's approximately 250 shareholders, invested in expeditions in search of the rumored Northeast Passage to China, and launched a series of trading ventures with Russia. Now, almost a half century later, Queen Elizabeth granted a charter to the largest trading concern, the East India Company, which was followed by the Royal African Company and the Hudson's Bay Company. These joint stock companies are, they're very, very, it is a sweet name, right? I wish they hadn't changed it to the Muscovy Company, but way better than what it was. I imagine it was just hard to put on the paperwork. But these companies were, again, they're very normal to us. We have stocks and corporations, and, that's just like a part of daily life. But at the time, they were sort of an ingenious financial structure. You were allowed to invest in the stock of a company, and then you would receive dividends or own a portion of that company. This was a relatively new idea, and it was a really good way to finance a risky concern. If you wanted to do trade, but you didn't want to risk your entire fortune, a great way to spread that risk around is to form a joint stock company. And they, as you know, they return positive returns on equity. They pay out dividends to their shareholders, usually cash, but sometimes cargo. And so these were really excellent financial instruments for propelling trade and boosting capital and making sure that things got done. And they were still actually pretty unsophisticated, though. Again, all the things we sort of take for granted, they didn't really figure out until much later. The East India Company itself, didn't have a persistent capital fund for most of its existence. Every new venture was supported with raising money or a short-term agreement well into the 1650s. And these were always made possible or legal by a royal charter or an act, and usually involved protections or privileges, and almost always a monopoly on trade. Importantly, these companies were tradable on the Amsterdam Stock Exchange and other stock exchanges as they came to be. Oh, that's not the wrong slide. Hold on a second. There we go. That's the right slide. So, um, these joint stock companies were part of an increasing, again, a financial revolution. And as part of this financial revolution was also sort of the key moment was the incorporation of the Bank of England, which was actually a private company, joint stock company, designed to help with the increasing debt problem. Now, the idea behind the Bank of England was that they would issue a 1.2 million pound loan, which is around 143 million pounds in today's money, furnished by merchants, bankers, other wealthy folks, at 8% interest. And it would get a monopoly on note issuance and deposit accounts, so basically a monopoly on being a bank. And in return, it would take a substantial portion of the English crown's debt. With this cash infusion, the English were able to finance the construction of new ships of the line, new shipyards, pay wages, and basically stay in the war. This is often credited with sort of turning around the 9 Years' War and basically propelling all of English expansion and competitiveness throughout the next 100 years. This financial whiz-bangery was essentially what allowed them to stay in the game. And a big part of this was that this was the first institution of fractional reserve banking. The Bank of England, other banks, other sort of like goldsmiths were the main ones, would issue notes and would store wealth, but the Bank of England was the first to lend out a portion of its assets, basically on the assumption that people aren't going to pull everything out at once, right? So having only a fractional of cash on hand allowed more money to be in circulation, which helped William and his troops win the war. It is a hell of an assumption, right? And so far, it worked. But as we all know, having lived through or having lived in the shadow of the Great Depression, sometimes there will be a run on banks, and that causes all kinds of problems. In fact, that repeatedly happens throughout history. It takes until the 21st century or the 20th century for governments to step in and make sure that it doesn't happen. But at the time, again, it seemed like a brilliant idea. But yeah, it was built on some pretty flimsy foundations. So, also in England at this time, is growing in sort of the shadow of the Royal Exchange, where a lot of this financial whiz-bangery happens, a place called Exchange Alley. And in Exchange Alley, it's exactly what it sounds like. There's exchanges done of mostly government debt, but also of stock, various financial instruments, lotteries, treasury notes, that sort of thing. The English crown, even when it had the benefit of the Bank of England, still needed to rely a lot on various fundraising measures. The regular taxation was not enough to keep the government solvent, and so from time to time, they would issue a lottery. It was very seedy. It was full of it was very much like Wall Street and today, full of at the time their stimulant of choice was coffee, but if they were modern day traders, they would be doing cocaine and just being real assholes to each other. It's exactly the same kind of financial atmosphere that you will find at any stock market, any big financial bank in the world. It's just 300 years earlier. So the government would pay out these or would issue these lotteries or issue debt, which they would pay out on. And much like treasury bonds today, they're not a very exciting way to make money, but they're a very consistent and reliable way to receive a small dividend consistently. You can count on it being the same payout, in um, basically forever. So, an important part of any safe investment portfolio. But a critical part of making that work is that there needs to be a secondary market for government credit. Right, you need to be able to trade or buy those securities and financial instruments. Otherwise, they're less valuable. And so, this exchange alley is where a lot of that stock trading happened. And the government was able to borrow more because people would buy shares in the national debt to ensure sort of a long-running stream of income. They would get regular interest payments from the Treasury, and the capital would stay with the problem was, though, that capital would stay with the government until the debt was paid off. There was no stipulation for paying it off early. In some cases, the government was legally prohibited from paying it off early if it wanted to refinance. And that was also a problem for the holders of that debt if they wanted to retrieve their capital ahead of time. Hence, Exchange Alley. It was a secondary market for Treasury's paper, and it was critical in that respect. So in 1697, the 9 Years' War ended, sort of inconsistently, the way that many of these wars do. And there were a few years of peace, but they didn't last. And let me find the right slide. Where are you, slide? There we go. In 1700, Charles II of Spain died without an heir, and Philip of Anjou, grandson of Louis XIV, was proclaimed king. Now, in 1700, the Spanish Empire, while not at its height, still included possessions in Italy, parts of the Netherlands, the Philippines, and the Americas, and was still quite powerful and wealthy. If either the Habsburgs or the Bourbons acquired it, it would radically change the balance of power in Europe, and hence the War of Spanish Succession, also sometimes known as Queen Anne's War. The Great Northern War involving Sweden and Russia might even be a part of this. There were conflicts in the Americas and in Africa. It was a very large and expensive war, as it was fought all around the world and required substantial numbers of troops and appeared to never be ending. And so the English crown found itself once again in trouble. So by 1713, and this war had been going on for quite some time, Britain's national debt, which was zero in 1693 and 7 million in 1697, was now at over 40 million, which is somewhere in the billions of dollars. I didn't do the math. Not to mention, this was substantially high interest debt. We here in America right now, in our glorious Fed-approved low interest rate utopia, are looking at interest rates in the 1s and 2%. But these treasury loans were 5, 6, 7, up to 9% in some cases. And like I mentioned, oftentimes they couldn't be discharged early, and there were legally binding agreements that those payments had to be made. So the total annual interest charge was £2.5 million, which was half of the nation's annual revenue. And so the parliamentarians, the people of the government, did an investigation and found that tried to sort of put this really messy, inconsistent, all these different debt sources together and make sense of it. And it concluded that there was a total of £9 million owed by the government with no income allocated to pay it off. These were particularly toxic and dangerous debts. They were not tied to any raise in taxes. They did not have any income specifically set aside to pay for them. And this was a particularly large problem. And so a couple of the government ministers, Edward Harley and John Blunt, who would be Well, sorry, I'm getting ahead of myself. Don't worry about John Blunt for now. They devised a scheme to consolidate debt in kind of the same way as they had with the Bank of England. They were going to consolidate the debt and essentially give it to a new company founded for the purpose of both buying the debt and for issuing shares and to be paid off through a monopoly on trade. And this was the South Sea Company. So the South Sea Company would assume a large portion of the debt, £9 million, and the government would make an annual payment to the company, 6% interest plus expenses, which would be distributed to the shareholders as a dividend. This was great because it allowed the government to sort of discharge a lot of their toxic debt and then make somebody else deal with it. It also added a lot of value to the South Sea Company. And in return for this, they sort of had a break on paying out that interest, and they received a monopoly on trade to South America. Now, keen listeners will probably be saying, well, wait a second, aren't they at war with Spain, which controls South America? And you'd be right. They are at war with Spain. Seems like a major oversight, but don't worry. Nobody cares. It doesn't seem to slow anybody down, and initial shares in the company are valued at over par, which is £100, in the 120s or 115s, 117s. So the company makes a tidy profit. Everybody is bullish on this new venture. And the South Sea Company is so confident that it collects a cargo of 1,000 tons worth £20,000 and plans to set sail for a voyage in... Hey, you made it. Welcome, Poisonous Kiefer. I was just talking about the South Sea Company, which was incorporated in 1711 with the express purpose of trading with South America, like I just said. Also, founding... the real reason for it, though, was to discharge government debt, English debt. Anyway, so they put together this ship intending to sail in 1712, again, still at war with Spain. And so they asked the crown for a armada to escort them to South America so they could trade. But the armada never materialized. Having gotten rid of the debt, the English crown wasn't particularly concerned with anything else. They had dealt with their major problem and had a war to fight. Now, from the perspective of an investor in the South Sea Company, this sounds a little bit strange, but truthfully, it's not a bad idea. The main function of this is to sort of work as a hybrid bank, basically to manage government debt. And so basically, they're just issuing out 6% dividends every year. And for a lot of people, this is totally fine. This is a nice, safe, modest investment. But the owners of the South Sea Company, they want a lot more than that. And again, they do have to make some money in order to pay off the collateral, and that is supposed to be paid through trading. And so it's not until 1715 that the first South Sea Company trading ship crosses the Atlantic. There are some more voyages, but by the end of 1718, the company only booked around £100,000 in profit, which is not a lot for how much debt they have taken on. And so they also receive, so in 1713, the Treaty of Utrecht ends the War of the Spanish Succession, and as part of the treaty agreement, England extracts as concessions an Asiento de Negros, which lasts 30 years, which is basically an agreement that allows Britain to supply slaves to the Spanish colonies, about 5,000 a year. Britain is also permitted to open offices in Buenos Aires, Caracas, Cartagena, Havana, Panama, Portobello, and Veracruz to arrange this trade. And this is a pretty substantial volume of trade. And yet, when all is said and done, it actually seems that the South Sea Company did not make any money from selling trades. Selling slaves. And the reason is kind of boring. Actually, they were just not very good at it. It turns out that even though it is a profitable and bloody and ruthless business, they sucked at selling slaves. They did not do a good job of getting them across the Atlantic. Once they got there, they were bamboozled by Spanish merchants who would sell them things in commodities rather than cash. The existing slave traders did not like them and sabotaged them at every turn. And so ultimately, they ended up not really making much money from this trade, which, again, didn't ultimately matter because the core business of the South Sea Company was managing the crown's debt, or sort of just functioning as a very simple sort of one job bank. But it did not justify sort of the rampant speculation or the excitement about its potential profitability that had been promised. And then in 1718, war broke out with Spain again in the War of the Quadruple Alliance. The company's assets in South America were seized at a cost of £300,000. And then, of course, they were not able to do any additional trading in South America. But that's okay, because something is about to happen that will make that not matter very much. That's the wrong slide. Whoops. Where am I? Hold on a sec. The slides are out of order. There we go. So in February of 1719, the House of Commons came up with a new idea for dealing with the rest of the national debt. Because, remember, only a portion of it had been converted into stock, and there was still a substantial amount that needed to be dealt with. And there, initially, they tested this by converting a portion of annuities issued during a 1710 lottery into South Sea stock. The company was granted the right to issue a certain amount of stock for every sort of £100 per year of annuity which was surrendered. The government would then pay 5% on the stock created, which would halve their bill. Remember, a lot of these lottery annuities were priced at 8 or 9%, and so this was basically refinancing in the form of South Sea stock. And this was just like a small-scale test, just a portion of one debt chunk that the government owed, and it was hugely popular. The company's shares shot up. It went very well, and so they decided to do it with a substantially larger portion of government debt. And it's worth mentioning that many of the people who were on the South Sea Company's board were either also elected members of government or very, very close with them, and members of parliament or ministers of some sort. This is all a lot of, I mean, there's inside trading in the illegal sense, and then there's inside trading in the, well, I mean, it's all unethical, but at the time in England, it was just sort of expected. Yes, this is the part where regular people start to buy stocks. But first, it's mostly just rich people. But at first it's, the only people really who can deal in stocks are the wealthy. But there's just expected to be a certain amount of self-dealing in England at this time, and really everywhere in government forever. But, now we have pretend rules that people pretend to follow. But at the time, it was expected that you would enrich yourself. But as a part of this plan, the members of the South Sea Company deliberately lobbied and bribed is the wrong word, but members of parliament absolutely financially benefited directly from this sale of stocks. And so they pass an act to sort of convert a bunch of government debt into South Sea stocks. This is also a kind of a debt for equity swap. People who held government debt would involuntarily instead have it converted to South Sea stock. They would have the same amount of technical assets, but that would be in South Sea stock instead of in government debt, which was fine for most people because that became very valuable very quickly. But it was still, a lot of. When I'm talking, I'm leaving out a bunch of like financial weirdness, which is new, and also I only vaguely understand. But everything that happens today with people, converting derivatives into one thing or another, or doing weird, behind the curtain stuff to boost the value of some asset to buy some other asset to, change the value of something else. That's all going on here. It's very exciting. But the real core element is that, driven largely by speculation and insane demand, South Sea stocks start going up. They're 198 pounds on March 29th, 220 on the 30th, 255 on April 1st, 275 on the 2nd, which is when the House of Commons approves the South Sea Act. And then the following day, they shoot up to 350 pounds. Yeah, short sell, pump and dump. That's exactly right. No, that's what's happening here. But also, it's it's a short sell combined with a pump and dump, combined with speculative asset bubble. It's everything at once. It's wild. It's amazing. It's terrible. Anyway, the shares go up to 350 pounds the day after the House of Commons approves this South Sea Act, and then they sort of settle a little bit lower than that. And like I mentioned, the shares were sold to politicians at the current market price, but they didn't pay for them. They just held on to the shares that they had been offered with the options of selling them back to the company when they chose, right? Receiving any, if they wanted profit, any increase in market price. This is how they won over the heads of government, right? The king, the king's mistress, all these ministers, members of parliament. It also meant that the government was extremely invested in the success of the South Sea Company. There was one parliamentarian, a crotchety old man named Archibald Hutchison, who did not buy into this. He was not impressed by this whole thing. And even though he held some South Sea stock himself, he was just not convinced of the viability of the whole scheme. Remember, this is all sort of dependent on the theoretic, right? Money has to come from somewhere eventually, right? The South Sea Company has a lot of leeway and forgiveness, but sooner or later people have to start getting paid. And so the fact that the South Sea Company did not actually have any profits was going to be a problem. And so Archibald Hutchison, who was not a mathematician or an economist himself, but was, sort of like capable of doing some basic arithmetic. And so he asked himself how much trading income the company would need to have in order to provide an adequate return for, sort of 200 a shares at 200 pounds a pop. He compared this to what you would get with any sort of other range of investments, right? If you had invested in anything else. A trading profit around 7 pounds for that. And so he summed this up and found that in order to pay out the dividends, in order to be a viable investment at that purchase price, right, the South Sea Company would need to make 3 million pounds in annual profit from trade in Spanish America a year. Which, as I've mentioned, so far in the entire existence of the South Sea Company, it has made 100,000 pounds in profit. Obviously, and this is at a 200-pound stock valuation, right? It's going to get higher. So already Archibald Hutchison is saying this isn't working, this doesn't make any sense. But would you believe it, folks? Nobody listens to Archibald Hutchison yet. Thus begins the bubble. And the speculation is rampant. It is wild. There is just a absolute fervor frenzy going on in the streets of London. And of course, the main beneficiary is the South Sea Company. Shares will eventually shoot up to £500, £700, £800, and ultimately peak at around £1,000. But the frenzy doesn't stop there. Everybody kind of wants to get in on this, and there's a limited number of South Sea Company stocks, and so a huge number of other joint stock companies are created, which make like extravagant and often fraudulent claims about foreign ventures or bizarre schemes. Some represented sound, potential business ideas, like an insurance company. But I think I read that after all was said and done, only 3 out of, I think, hundreds of companies formed during this time period still existed 40 years later. And these included things like ideas to extract silver from lead, buying Irish bogs, trading in ambergris and ostrich feathers. There's one famous advertisement from May 21st, which is for raising the sum of 6 million sterling to carry on a design of more general advantage and of more certain profit. No further details. That's it. Somebody formed a company with the express purpose of buying Irish bogs. I'm not sure what the sort of like profit. No, I don't know. Let me ask you an unrelated question. Where does the profit in creating a very expensive machine that squeezes juice come from? Or how about a device that takes your blood with one finger prick but actually doesn't exist yet? I'm just saying, just because they don't know how they're going to make money off of the Irish bogs doesn't mean that there's no plan there. I mean, it does mean there's no plan there, but I imagine it. They'll figure it out. The thing is, they'll raise the money and then they'll figure it out. So by the end of this bubble, Exchange Alley prices the South Sea Company has issued multiple stock issuances like during the summer of 1720. And at this point, there are thousands of shares going around, and its shares are hovering at £1,000 a piece in August. So, which means that Exchange Alley is sort of pricing the South Sea Company as a whole, at about half the total value of every business traded on London's financial market. Around £500 million. For context, that much money could have bought all of the fixed property, all of the real estate, every acre of useful land, and all of the buildings on it in the entirety of Great Britain. So you might be saying, Rob, that doesn't sound right. How could that possibly be right? The South Sea Company doesn't have any assets whatsoever, and no profit. And you know what? You would be right. And it starts to drop. By the end of 1720, remember, the price finally reaches its peak out of £1,000 in August. By the end of 1720, it had dropped down to £100 per share, which was before lower substantially than it was when the first stock was issued after the South Sea Act. Not to mention, in August, the first installment payments on the money subscriptions were due, which meant that things started to sort of accelerate. Because of these, now, when I say that everybody was in on this, I mean everybody was in on this. Every widow, every cabbie, every person who could scrape together enough money to purchase any South Sea stock had gotten in on this. Sir Isaac Newton, a very, very smart man, sold his stock for a profit when it was around £300, and then bought back in because he could not resist the urge. This is a really, I think this is actually a really important lesson from the South Sea bubble, is that, well, one, markets are not rational. Two, people are not rational. But also social pressure, social engagement, just being a part of something is an incredibly powerful and intoxicating mix. And even otherwise, like, smart, rational, reasonable people can end up making what turn out to be not very wise financial decisions, which seem good at the time. I am not going to mention any specific financial boondoggles that are happening right this moment as we speak. And I'm sure that everything that everybody is putting money into will go right to the moon. But just because I look at something that is based on, just because we look at something that doesn't have any value behind it whatsoever, and is confusingly both a store of value and an asset, doesn't mean that it's actually irrational or for people to be jumping on and trying to be a part of it. Some of them are just trying to ride the lightning and make money. But some of them, they're making a good decision based on, or the best decision that they can based on what their peers are doing. And that's a lot of what happens here. It's also worth mentioning that this is still relatively new in the financial revolution. A lot of these financial assets, stock trading, are recent developments. People, even smart investors, are not sophisticated necessarily in the ways in which they might lose all of their money. That being said, some are. A man named, I want to draw to your attention, like, before we get out of this bubble, but a man named Thomas Guy, it's a name, Thomas Guy, saw what was happening, and he owned a substantial portion of South Sea Company shares, and when they were at around £300, he sold. He just sold them and walked away. He was, even though the shares would rise 3 times after that, he just walked away, and took in a total of around £250, on the order of £400 million now, and he became extremely wealthy off of that. In fact, he donated a substantial portion of his wealth to build a hospital in Southwark. Sorry, English people don't get mad at me. Which is now called Guy's Hospital. It's still there. It's enormous. It's got, I think it's got 19 buildings. You can still go see it today. That's right. Buy the dip. Well, here's the thing: is it's good to buy the dip. But then you have to sell. This is the problem. Never mind. I'm not going to get into the whole thing. The thing is, like, somebody will come back and watch this like a year later and be like, "What are you like?" If I start mentioning Doge and Bitcoin and GME, people are going to be like, "What is this guy talking about?" So I'm trying not to date myself too much, but just what I'm talking about. Anyway, so by 17, so company failures, the stock crashes down to 150, down to 100 eventually. Banks and goldsmiths failed. They couldn't collect loans. Thousands of individuals ruined, including a lot of members of the aristocracy. And Parliament was recalled, and they're angry, and they start to investigate. It reveals that there's widespread fraud among the company directors and corruption in the cabinet. One of the things that the company did, which was a lot of the things they did were deceptive and unethical, but the one thing that they did that was actually illegal was they did stock buybacks. By the way, if you wanted to look at something that was a totally good decision and has no repercussions whatsoever, stock buybacks used to be illegal in this country as well until 1980s, sometime around then, when Ronald Reagan made them legal again. and nothing bad has happened since then. Anyway, they were illegal, and one of the things that the South Sea Company had done was do stock buybacks to sort of boost the value of their stock, because, as you figured out, the only way that this scheme works is if the stock continues to go up. But it didn't. Anyway, so John Aislabie, actually I don't know how to say that, who was the Chancellor of the Exchequer, James Cragg the Elder and the Younger, who were Postmaster General and Southern Secretary respectively, and Lord Stanhope and Lord Sunderland, the heads of the ministry, were all implicated in fraud and misleading the public. The Craggs died in disgrace. The rest were impeached. They were accused of the most notorious, dangerous, and infamous corruption. Aislabie was actually imprisoned. Luckily for him, Robert Walpole, who is really significant in this, who had been a man of substantial power and influence in government, had been ousted right before the South Sea Scheme, as government switched from Tories to Whigs. Again, they're basically the same people at this time, so don't worry too much about that. He managed to avoid getting implicated in any of this, even though I think he financially benefited and probably had been bribed. Nobody was ever able to prove it. And he stepped in after all of this, restored public confidence in the financial system, removed 33 of the company's directors and stripped them of their wealth, which was used to pay back dividends and sort of make the government whole. Walpole also managed to make sure that King George and his mistresses didn't end up with any of the mud on them, and saved some key government officials from impeachment. Well, the reason why we don't do that now, that's a great question. I don't have a good answer for that. In the process, he basically saved the entire English government, the Hanoverian crown, from disgrace. The government came within a hair's breadth of basically defaulting and collapsing. And I really wish that I had like a big like tidy takeaway from this, because it's such like an interesting story. But the truth is that nobody really seemed to learn anything from this. Bubbles would and continue to happen. Some people ended up going to jail, but not everybody. The South Sea Company continued to exist, though it was mostly just responsible for, again, maintaining that debt. Right. What we learned is that the stocks need to keep going up, right? That's the only thing that we learned. But it's so interesting, right? Because this is really just sort of like beat for beat, something that we see happening day in and day out. The lure of easy money is just something that we humans are not very well equipped to resist, and it just keeps happening. It's going to keep happening until you make it illegal. But the South Sea Company and the South Sea Bubble is just so interesting to me because it's based on nothing, and everyone knows it's based on nothing, and at no point is there really any profit behind it, and yet it all happens anyway. It's not the first bubble, but it is one of the earliest, and it's one of the biggest. It is it's just a fascinating, it's just to the moon, folks. The lesson is that if you're in a bubble, it is interesting because of government debt, and this is the interesting. It's boring, but it's also a very interesting part of English history because England is beginning an experiment in deficit spending, which turns out to be really significant in the modern era. It allows governments to do a lot more than they could otherwise. And there are people who are sort of like toying with really understanding things like adjusting interest rates to support investment, even things like stimulus, Keynesian economics. But they're not really doing that. They're just sort of like guessing at it. But you sort of see the beginnings and the inklings of a lot of how we manage our debt today, but very, very poorly. Um, and yeah, it's not until much, much later that the sort of the modern version of deficit spending and federal banking and all that starts to emerge. But you see, sort of, people are starting to figure out that if you do things, again, if you do weird things with money, you can goose the system, and you can also incentivize people. But it's always sort of a gamble, right? It's a game, right? You have to make sure that you're not spending too much more that you're bringing in, that you're not that your fractional reserves are not too low, that you're not cutting up and dividing your assets too small, which is frankly, honestly, it feels like what we're doing now. Everybody's trying to see just how much they can get away with, and then and then there's a crash, and a bunch of ordinary people are ruined. That's the lesson, folks. Thank you all for listening. Happy Friday. I'll see you all next week. I hope you all are doing well. Get vaccinated. You're the best. I'll talk to you later. Good night.